First and foremost, let's understand what exactly is credit, and then let's ask the question, what exactly is credit risk? There are broadly three ways in which individuals or businesses or enterprises can raise money. There is equity, which basically implies the owner's own money in business, which is, for example, equity share capital or a proprietor's capital in a proprietor's business. Then there is debt or a loan, what is exactly called as a credit. And then there are certain hybrid instruments, for example, preference shares and convertibles. So these are the broad three ways of raising capital or money for business or even by the individual. So let's understand more deeply the meaning of credit and its characteristics. Unlike equity, there is an obligation to service the debt or credit and also to repay. In most cases, the obligation is fixed. For example, the interest rate is fixed. When you have to repay is fixed. And then if there are the other terms and conditions, they are also fixed in the contract. The repayment as well as servicing of the debt or credit is always mandatory. In case you are not able to service the debt or repay the debt, then it can lead to litigation as well as bankruptcy. Any kind of a credit instrument or facility establishes the relationship of a lender and borrower between the two entities. There are various ways of classifying different types of credit instruments. For example, there are funded instruments like term loans, working capitals, bonds, where the lender releases the funds at the time of granting the credit. Then there are non-fund based credit agreements. For example, the guarantees that are issued by the bankers or the letter of credit or letter of comfort that are issued by the bankers are typical examples of non-fund based credit facilities. There are various types of credit instruments. For example, there are bonds, there are government securities, there are commercial papers, there are bills, and there are certificate of deposits. Now, let's try to define what is a credit risk. This is a bit of a complicated or technical definition, but let's go through that. Credit risk refers to the probability of the loss due to non-recovery of or emanating from the credit extended as a result of the non-fulfillment of contractual obligations arising from unwillingness or inability of the counterparty or for any other reason. Now, let's break down this definition and understand the characteristics of a credit risk. The credit risk arises from the probability of non-repayment or non-servicing of the debt. So it's a probability. It is not an eventuality that is given. Also, the non-repayment or non-servicing can happen either with the willingness of the borrower, that is, the borrower might default willingly or purposely, or it may be beyond the reasons of the borrower, or it could be something where he has no ability to service the debt. A risk of non-repayment is very clear. You have your bond repayment due, your term loan repayment due, and it is not being made. The risk of non-servicing is, for example, non-payment of the interest or coupon. Other examples of non-servicing can include the non-fulfillment of the other terms of the contracts. For example, if the bonds have been issued against collateral of an asset, but you are not being given the documents that you are required to be given to note the mortgage on those assets. That is also an example of non-servicing of the debt contract. A delay in repayment or delay in servicing is also an example of a credit risk, or part payment instead of the full payment is also an example of a credit risk. The credit risk is also known as the default risk and also at times known as the counterparty risk. I hope you have understood the meaning of what is credit and what is credit risk in this short video. If you like this video, please do subscribe to my channel as well as put down in the comments if you have any other questions. Thank you very much. Cheers.